In today's video, I'm going to talk about the latest numbers we have regarding foreclosures in the United States. I want to talk about the residential market, but first I want to talk about the commercial market as well. Some very big changes regarding foreclosures on a national level. This is from ATTOM or ATTOM, just posted on April 17th. It says commercial foreclosures increased 6% from last month and rose by 117% from last year. The states with the most commercial foreclosures in March 2024 included California, New York, and Florida. So one thing that is different regarding commercial valuations and foreclosures compared to residential is that residential, your home value is dependent on other properties that are close to you, what they sold for. So you look at comparable sales. For commercial real estate, look at your vacancy rate. So if you purchased a property back in 2022 and your occupancy was at 98%, meaning only 2% was vacant, but fast forward a year later, and if your vacancy rate increased to 50%, in other words, your building is half empty, that would mean approximately that your valuation of your building just decreased by 50%. So your valuation on commercial properties is dependent on how many tenants you have in there, which is much different compared to the residential real estate market. So in any case, here's a chart that they shared looking at foreclosure rates for commercial buildings. And see here back in, this is the latest data they have from them is in March. There was 625 commercial buildings that were foreclosed on. Besides January, this is the highest rates we've had going back to approximately 2015. Also, the current numbers we have right now are much higher compared to May 2020, when of course we had COVID lockdowns, but all these initiatives that caused foreclosures to be halted altogether. And actually touch on that right here. In May 2020, the US saw a significant low in commercial foreclosures, hitting only 141, reflecting the immediate impacts of the pandemic and the swift response measures like foreclosure moratoriums and financial aid. By March of 2024, commercial foreclosures had risen to 625, a 117% year-over-year increase compared to the 2020 low. In March 2024, California had the highest number of foreclosure properties of commercial properties for the month at 187. That was an 8% decrease from last month, but a 405% increase from 1 year ago. California began experiencing a notable rise in commercial foreclosures back in November 2023. Meanwhile, after California, the next highest rate was actually in New York at 61 commercial foreclosures in March. That was a 5% gain from last month and a big increase up by 65% from a year ago. After that, we had Florida up by 30% from last month, up by 107% from last year. Then we have Texas up by 31% from February and a giant increase of 129% year over year. Then New Jersey, also big gains, up by 31% from last month and up by 133% from 12 months ago. Now stay tuned for the latest developments on that. And of course, I'll definitely keep you posted. Let's talk about the residential foreclosure stats right now though. This is posted on April 11th, again from ATTOM or ATTOM. It says a total of 95,341 US properties had a foreclosure filing during the first quarter this year, up 3% from the previous quarter and down less than 1% from 1 year ago. This report also shows that there was around 33,000 US properties with a foreclosure filing. This is not a completed foreclosure, just a filing this month. That's down by 1% from February and down 10% from 1 year ago. So overall, foreclosure filings this March decreased from February and also decreased by 10% from March 2023. Their CEO stated the following: while foreclosures remain relatively stable, we're closely monitoring these trends. Homeowners continue to hold on to significant equity, contributing to the persistently hot housing market. As I reported to you guys a few days ago, Redfin just announced that existing home sold prices, or I should say the median sold price, reached a new all-time record high. On top of that, a lot of people have equity in their houses as well, unless you bought a house at the peak and you paid way over the appraised value back in 2022, right? In any case, Corelogic announced that U.S. homeowners with mortgages, so approximately 62% of houses have a mortgage. This means that approximately what? 38% do not have a mortgage and they have no loan on their houses. So in any case, for these people who do have a loan on their house, their equity just increased by $1.3 trillion since the fourth quarter of 2022, a gain of 8.6% on a year-over-year basis. And this, by the way, covers Q4 of 2023, a giant increase of 8.6% compared to Q4 of 2022. So not only do Americans have a lot of equity in their houses in general, but also there's very few amount of people who have negative equity in their houses. In other words, they owe more on their house than their home is worth. That's approximately 1.8% of all mortgage properties have negative equity right now. And that has decreased by 15% compared to the fourth quarter of 2022. What's also helping Americans as well regarding foreclosures, of course, is due to the increase in home prices, but also due to the fact that approximately 96% of people who have loans on their houses have a fixed rate mortgage. Here's a really good chart I found on ResiClubAnalytics.com, a fantastic website if you guys want to see analytics regarding the U.S. housing market. It says among U.S. mortgage borrowers, people who have loans on their houses, 96% have long-term fixed rates, with a majority being 30-year fixed rate mortgages. Of course, a lot of people have, or not a lot of people, but some people have 15-year loans as well. In contrast, look at these other countries. Finland, 95.4% for people who have a loan on their houses have a variable rate. In other words, it's fixed for up to 1 year. Can you imagine buying a house in which your loan or your rate is only fixed for 1 year? I mean, look at what happened over the past couple of years. Rates have been absolutely skyrocketing. And I couldn't even imagine being a homeowner and have to go through, I don't know if they have to refinance every year or if their rate just is variable and adjusts every year. But in the United States, we are blessed to have 30-year fixed rate mortgages in which your principal and interest payment will not fluctuate at all as long as you don't sell your house. And of course, as long as you don't refi your mortgage, which is much different compared to these other countries. Australia, 74.1% have a variable rate and only up to a 1 year fix. Ireland at 55.9%. Sweden, 48.3%. 50.5% in Sweden have a short-term rate. It's only fixed for 1 to 5 years. Canada, I have a family member in Canada who is a real estate agent in Toronto. I was telling them last time we visited that we have 30-year fixed rate mortgages. And they were just like, one person I was talking to works in, he works in the residential housing industry. But I was telling him we have 30-year fixed rate mortgages. And he was just like jaw dropped because in Canada, it's more normal to have a fixed year loan in the range of 3, 5, 7 years, maybe 10 years. And the chart here shows that as well, because in Canada, 20.6% have a variable rate, only fixed for up to 1 year. 32.5% have a rate that's fixed for only 1 to 5 years, and 46.9% have a fixed term of 5 to 10 years. So in Canada, you have to refi your loan. In other words, you have to requalify for a loan once your loan becomes variable. And so what happens if you lose your job? I don't know how that works. Anyways, we're blessed in the United States here, less than a 5% share who have a loan that's less than 1 year fix. This is according to Lance Lambert, by the way. I spoke to him a couple months ago. Great guy. And by the way, I hope to have him on the channel too as well. So stay tuned on that. He quoted the Dallas Fed in their January report. The unusually large proportion of long-term fixed rate mortgages in the U.S. is partly a result of government-backed secondary market institutions such as Fannie Mae and Freddie Mac. That help reduce costs for these mortgages. Securitization through these institutions allows U.S. mortgages to be held and traded by investors worldwide. So what happens in the U.S., you buy a house, you might get a letter, very soon after saying, hey, your loan just got, transferred to Fannie Mae or Freddie Mac. And so what they do there is they buy loans, and that frees up more cash for your lender. So your lender has more funds to lend out to more people to buy houses. That's what we have in the United States. Outside the US though, variable rate and short-term fixed rate mortgages are more common because banks, which dominate mortgage lending in these countries, hold loans on their balance sheets funded by deposits. So in other words, in these countries here, if you go to a bank, they'll give you the money, but they'll hold on to that loan. Whereas in most cases in America, that lender sells that loan to an investor, which frees up more cash to lend to other home buyers. The author, Lance Lambert, and also the founder of ResiAnalytics.com also points this out as well, which is a very good reminder here. It's important to note that while many homeowners' monthly mortgage payments may be shielded from spiked interest rates, in other words, the vast majority of us do not have a variable rate for our mortgages, but in unemployment or employment situations may not be. And of course, a lot of people have a lack of savings. In other words, what he's saying here is that the unemployment situation is also tied directly to the healthiness of our housing market as well. And overall, we're not seeing a giant spike of unemployment, but if we do, a lot of Americans have a lack of savings, which I'll share with you guys in a little bit, and that could lead to more distressed home sales later this year potentially. All right, let's also talk about another report as well. This is from Corelogic, just posted on April 25th. This covers through February 2024. So overall, in February this year, the overall mortgage delinquency rate is at 2.8%. 1 year ago, it was at 3%. So it has decreased by 0.2 percentage points over the past 12 months. According to the principal economist for Corelogic, she stated the following: the U.S. delinquency rate fell from a year earlier for the first time in 6 months in February, indicating that mortgage performance remains strong. The decrease in delinquencies was driven by the decrease in the share of mortgages that were 6 months or more past due, a number that has been consistently shrinking and fell to its lowest levels in 15 years in February. So a key early indication of future foreclosures, by the way, is looking at people who are really late on their paying on their mortgages. So in California, you can't start the foreclosure process until you're at least 90 days or more past due. I would imagine that varies by the state, but looking at people who are really late on paying their payments, that would be a really good indication regarding future foreclosures as well. But right now, we're not just seeing that just yet. In regards to that, she says, as later stage delinquencies decrease, the share of mortgages in foreclosures remain at 0.3% in February, where it has been since March 2022, and only slightly higher than the all-time record low. They also provided this as well, some select states, because again, the overall rate is at 2.8%. However, Louisiana is at 5.6%. Then we have Mississippi at 5.4%, New York at 4%. Then we have Alabama, West Virginia, and Maryland. By the way, all these states decreased compared to February 2023, except for Louisiana, that increased by 0.1 percentage points. Corelogic also provided this as well. This is the top 10 states that have the highest share of serious delinquency rates. This means they're at least 90 days or more past due. So leading the nation is actually Louisiana at a 2% rate. Then we have New York, Mississippi, Hawaii, DC, Illinois, Oklahoma, Alabama, Maryland, and Pennsylvania. Corelogic also provided how each of the biggest metros fared as well. So there was only 3 metro areas on a national level in which their serious delinquency rate actually increased. In contrast, there was 25 that were the same and 356 metros in which the rate actually decreased compared to 1 year ago. Now, something I'm kind of concerned about is this right here. This is according to our good Uncle Fred, And of course, the source is the Fed. This is the amount of consumer credit card debt. That's at $1 trillion or $1.3 trillion right now, and also a new all-time record high as of February this year. Nearly $1.4 trillion of credit card debt, much higher compared to pre-pandemic levels. So for example, back in, let's just say February of 2019, there was only 1.06 trillion. Now there's $1.338 trillion. And of course, way higher compared to the Great Recession, when the levels was around $1 trillion. On top of that, the delinquency rate is also very high as well. So that rate is at 3.10%. This is the delinquency rate on credit cards, by the way. It's at 3.10% for Q4 2023, which is much higher compared to pre-pandemic era, when the rate was around 2.6%. Looking at the past, what is this, early 1990s, at 3.10%. This is the highest rates we've had going back to Q4 of 2011. To make matters worse, the personal savings rate as of February of 2024 is only 3.6%. Looking at pre-COVID levels, it was around 6 to about 8.5%. So the personal savings rate at very low levels right now. In fact, going back to January of 2008, when looking at pre-COVID levels, the personal savings rate at 3.6% is the lowest rate since August of 2008. And with that said, please comment below with your biggest takeaways from today's video. Also, if you guys got any value out of this video whatsoever, then please hit the like button. I quite appreciate that. Of course, appreciate you. Hope you guys have an awesome day and look forward to seeing you on the next video.